Hey everyone, welcome back to the channel. Today, we re-diving into a hot topic in the world of real estate investing. Fractional real estate versus REIT. I'm calling this the 2026 Showdown because as we look ahead, understanding which of these is right for you is going to be crucial. So, grab a coffee, settle in, and let's break it down. First off, what's the big idea behind both of these? Simple. They both let you invest in real estate without having to buy an entire property yourself. Think of it like buying a slice of a pizza instead of the whole pie. You get to enjoy the taste of real estate returns, but with a much smaller initial investment. This opens up the market to a lot more people, which is fantastic. But, and this is a big but, they work in very different ways. And those differences can have a huge impact on your money, your control, and your overall experience. Let's start with the classic, the one you've probably heard of. REITs. That stands for Real Estate Investment Trusts. A REIT is basically a company that owns, and often operates, a whole bunch of income-producing real estate. We're talking about massive portfolios. Here's shopping malls, office buildings, apartment complexes, warehouses, you name it. When you buy a share of a REIT, you're buying a tiny piece of that huge, diversified portfolio. The best way to think about a REIT is like a mutual fund for real estate. You buy shares on the stock market. Host, like UD, buy shares of Apple or Tesla. This makes them super liquid. You can buy and sell your shares easily on any trading day. This ease of access is a massive plus. You also get instant diversification. One share can give you exposure to hundreds of properties across different states or even countries. Another big advantage, REITs are legally required to pay out at least 90% of their taxable income to shareholders as dividends. This can create a steady stream of passive income, which is a major goal for many investors. So, to recap REITs, they're liquid, they're diversified, and they often pay regular dividends. They are managed by professionals, so it's a completely hands-off investment. You just buy the stock and let the company handle everything else? Sounds pretty good, right? But there are downsides. Because REITs are traded on the stock market, their value can swing up and down with the overall market sentiment. A bad day for the S&P 500 can be a bad day for your REIT, even if the underlying real estate is doing just fine. This is what we call market correlation. You don't have any say in which properties the REIT buys or sells. You're putting all your trust in the management team. And finally, because you're a shareholder in a large corporation, you don't really feel that direct connection to the properties. You own a piece of paper, not a piece of a building. Okay, now let's talk about the new kid on the block, the challenger. Fractional real estate. This is a much more direct way to own property. Instead of buying shares in a company that owns real estate, you're buying an actual, direct ownership stake in a specific property. Let's say there's a beautiful vacation home in a popular tourist spot, or a new apartment building in a growing city. Through a fractional ownership platform, you and a group of other investors can pool your money to buy that single property together. So, if a property costs $1 million, and there are 100 investors, each person might put in $10,000 for a 1% ownership stake. You get a deed or a share in an LLC that directly owns that one building. See the difference? It's not a stock, it's direct ownership. The biggest pro here is transparency and control. You get to choose the exact property you want to invest in. You can research the neighborhood, look at the property's financials, and decide if that specific asset fits your strategy. You're not just buying into a blind pool of assets. Your investment's performance is tied directly to how that one property performs, the rent it collects, and how its value appreciates. It's not tied to the whims of the stock market. If the property value goes up, your share's value goes up. It's that simple and direct. This direct link also means you can potentially see higher returns. While REITs have management fees and corporate overhead, fractional ownership can be more streamlined. You're cutting out some of the middlemen. Plus, you get that feeling of tangible ownership. You can point to a building and say, I own a piece of that. For some people, that's a really powerful and motivating feeling. But of course, fractional ownership has its own set of challenges. The biggest one is liquidity. It's not like a stock you can sell in a second. Selling your share usually means finding a buyer on the platform's secondary market, or waiting for a predetermined holding period to end. which is often several years. It's much less liquid than a REIT. Also, you lose that instant diversification. Your investment is concentrated in one single property. If that property has a long vacancy or needs a major, unexpected repair, it can directly hit your returns. With a REIT, one problem property is just a tiny drop in a very large bucket. With fractional ownership, that one property asterisk is asterisk the bucket. So the risk is more concentrated. You need to do your homework on each specific property you invest in. So, let's put them head to head. The 2026 Showdown. What's the verdict? The truth is, there's no single winner. The best choice depends entirely on you, your goals, your risk tolerance, and how involved you want to be. Let's imagine two different investors. First, there's Sarah. Sarah is busy with her career and family. She wants to add real estate to her portfolio for diversification and passive income, but she doesn't have time to research individual properties. She wants something she can buy, easily hold for the long term, and not think about too much. For Sarah, a REIT is probably the perfect fit. She can buy it through her existing brokerage account, get instant diversification, and receive regular dividends. It's a simple, set it and forget it approach. Now let's think about Ben. Ben loves real estate. He enjoys scrolling through listings, analyzing neighborhoods, and digging into the numbers of a potential deal. He wants more control and believes he can pick winning properties. He's willing to trade some liquidity for the potential of higher, non-market correlated returns. For Ben, fractional ownership is a dream come true. He can handpick the properties that match his specific strategy, whether it's short-term rentals, long-term rentals, or commercial spaces. He's more of an active hands-on investor, even if he's not managing the property data. Looking ahead to 2026 and beyond, I see both of these models growing. Technology is making fractional ownership easier and more accessible every day. Platforms are getting better, more transparent, and are starting to build more robust secondary markets to help with that liquidity issue. At the same time, REITs will continue to be a pillar of real estate investing for the masses due to their simplicity and scale. So, my advice to you is this. Do you want to think of it as an either-or situation? Think of it as both and. You could have a core holding of a diversified low-cost REIT for stability and broad market exposure. Then, you could complement that with a few carefully selected fractional ownership investments in properties or markets you strongly believe in. This gives you the best of both worlds. The stability and liquidity of REITs, combined with the high growth potential and direct ownership of fractional real estate. Ultimately, education is your most powerful tool. Understand the mechanics of each. Read the fine print on any fractional platform. Look at the expense ratios and management history of any REIT. The more you know, the more confident you'll be in your decisions. Real estate has created incredible wealth for generations. And now, with options like these, it's more accessible than ever before. The key is to find the path that aligns with your personal financial journey. What do you think? Are you Team REIT or Team Fractional? Or maybe you're like me and see a place for both in a modern investment portfolio. Let me know your thoughts down in the comments below. I'd love to hear your experiences and which approach you're leaning towards for your own financial future. Thanks so much for watching. If you found this breakdown helpful, do me a favor and hit that like button and subscribe for more deep dives into smart investing. Until next time, happy investing.